Hi, welcome you back. What is the private equity? Many of you already familiar with the word private equity. What do private equity firm actually do? What the different type of the strategies they work upon? What is the typical structure of a PE firm? In this video, we will talk about private equities. We learn all the question we have been mentioned above. PE is short form the private equity. So let's start first thing first. The name itself says, let's elaborate the name. What is the P? Private equity. If we segregate this, private and equity, there are two components. Private means that private equities only invest in the private companies. They are not invest in the public listed companies. And equity means these PEs are only invest in the equities, not in debt. So without any delay, let's get ahead. Alright, so as here we can see the definition of a private equity. This is the definition of the Investopedia. You can go read by yourself that what is the private equity. Private equity is an alternate investment class and consists of the capital that is not listed on the public exchange. As earlier we have said that P's are only acquiring the companies which are not listed in the stock exchange. First thing you should understand, there are two types of the companies, private limited and another is public listed companies. The companies which have issues is IPO and listed in the stock exchange, that is the public company. So P's are a alternative investment class. It's a like mutual fund, hedge fund. P's are also a kind of the fund, you can say that, which are only interested to acquiring the private companies which are not listed in the stock exchange. If there is a company which are already listed in the stock exchange, P is usually invested in the private company. They are not interested to invest in the public traded companies. So first they delist the equities from the stock exchange, then invest. There is some distressed company which required a huge capital and some P's are interested to buy it out. So first they go and delist the company from the stock exchange. They acquire the stake in the company, then they change the management, they improve the financial. We will gradually learn all the things. So this is the basic definition of the private equity. So apart from the definition, let's understand some basic component of the private equity. The first thing, private equity firm typically invest into the private companies. Private equity acquire the startup and distressed companies. There are, you heard about the angel investor and venture capitalists. These all are the private equity firms. They interested to acquire the younger company, startup or a distressed company. Private equity is investment class and consists of the capital that is not listed on the public exchange. Private equity always invest in the private companies. If they want to invest in the public traded company, so first thing they list the company from the stock exchange, then they invest. They improve the management and financial, and after that they exit from the company when it's start the making profit. Typically PE exit from that point. Private equity has two significant body structure, LPs and GPs. What LPs are the investor whose money is in the private equity, and GPs are the general partner who are the responsible to manage those money of the investors. So there are two major bodies, limited partner and general partners. Limited partners are those who have the money, high worth individuals and institutional investors, and general partners are the manager of those money. They find the target company, they acquire, they manage those money and making the profit for the LPs. Alright, limited partners are the investor of the Ps who put their money into the Ps. They are high worth individuals or institutional investors who give their money to the Ps, and general partners are who managing those funds. As first you can see, high worth individual or institutional investors who provide capital to the PEs. They have limited liabilities in PE firm. They invest their money and only objective a high return. They are not involved in portfolio selection or fund management. They pay fee to the GPs, general partner, who manage their money. LPs are the investor of the PE firm. These are the attributes of the LPs. LPs are only invest their money. They put their capital in the PE firm, and GPs are responsible to manage those funds, and the LPs, limited partners, are paying the fee for the managing their money. And other hand, let's get the attribute of the general partners. GP are the responsible for, they have the whole liabilities of a private equity fund. They are fully responsible to manage the fund of the LPs, find the target company and manage the portfolio, post investment advisory. They charge the fee to the LPs. General fee structure of the industry is 2% and 20%. 2% are the management fee and 20% are the share in the profit. 2% are charged annually, whether make any profit or not. They charge 2% irrespective of the fund size. So these are the general attributes of the limited partner and general partners. Okay, these are the some strategies private equities are work upon. Most of you already knows about the venture capital and angel investor. These all are the equity firm which are interested to acquire a younger company, suppose a startup, and there are some Ps are only interested in the specific industries. Suppose some are only interested in the IT sector, some are only interested in the FMCG, some are interested to the biotech. So there are industry specific Ps are which only invest in the target industries companies. PE invest into the distressed companies and change its management, improve the financial performance, and then wait for the 5 to 10 years when company again is starting profit, then their Ps sell the stock in the higher price than they brought, then they take their profit and exit from the company. LBOs, this is the very important part of the private equities and merger and acquisition. LBO is a leverage buyout, as name itself said, leverage buyout. So this is the strategy: acquire a target company using its asset as a collateral and take the debt from that asset and pay the cost of the acquiring. Seems very complex. LBO in simple language, let's understand that a PE firm go to acquire a company A. They go and acquire the company and they put the company's asset, the target company which they acquired, they use their asset as a collateral and take the debt on that asset, and from that debt they compensate their cost of acquiring. Maybe in future we will make the videos when we talk about the merger and acquisition. If we get the demand from our viewers, we will make a separate video on the LBO. P is also involved in the board of the target company to improve the governance of the company. They consistently providing the advisory and all assistance to improve the efficiency of the management and governance. That company should be make profit and it's go for the IPOs. All P companies are interested that company should earlier go for the IPOs and it's make profit. When it's making profit, that is the time then private equity firm can sell their stock at higher price and exit from that company. If you want to understand in detail, these are the some famous private equity firm of the world: Blackstone, Vista, the Cali Group. Go to their website and learn about their operation, their management. And even if you want to learn about the Ps, we are given the website link, FinAnalytic Capital Private Limited, in the description. You go over there and check it out. So if you have any doubt, please drop the comment. See you in the next video. Thank you.